Hello traders and welcome back to the Forex Geek. In today's video, we're going to be talking about a powerful trading strategy that could improve your approach to the markets. We're talking about the double moving average crossover strategy. So, this strategy is a time-tested method used by both novice and experienced traders to identify potential trend changes and generate buy or sell signals. This strategy's simplicity and effectiveness make it a valuable addition to any trader's toolkit. As we explore its intricacies, you will learn how to implement this strategy, understand its strengths and limitations, and discover advanced techniques to enhance your trading decisions and strategies. So stay tuned until the end to unlock the full potential of this strategy and take your trading to the next level. Without wasting any much of your time, let's get started. So the double moving average crossover strategy operates on a straightforward principle. When a faster moving average crosses above or below a slower moving average, it signals a potential change in market direction. So the first step is to choose your trading platform. Here I'm on the TradingView platform, and you could use the MetaTrader platform. So you need two moving average. You need to apply two moving averages to your chart, which I'm going to do right now. I'm going to apply the moving average. I'm going to use the simple moving average. Moving average. I'm going to be using the simple moving average. And like I said, we need a faster moving average and a slower moving average. For the slower moving average, I'm going to be using the 50-day moving average, and this is for the for the uh for the long-term moving average, or I'm going to be using the 200-day moving average. For the short-term moving average, I'm using the 50-day moving average. For the long-term, I'm using the 200-day moving average. I'm just going to go edit the color of the long-term to red color. So for the 50-day, the blue color, and for the 200-day, the red color. So let's just wait for this to load on the charts. Okay, we have it on the charts right now, and this is the faster and the slower day period moving average. So when the faster moving average crosses above the slower one, it generates a buy signal. When the 50-day crosses above the 200-day, it generates a buy signal, indicating that momentum is shifting upwards. Conversely, when the faster moving average crosses below the slower one, it produces a sell signal, suggesting downward momentum. So the beauty of this strategy lies in its ability to help you identify trend changes before they become obvious to the majority of traders. So by watching these crossovers, you can position yourself early enough in potential trend reversals while maintaining a systematic approach to your trading. So let's quickly look at the charts and try to spot these crossovers and how you can use them, how you can trade them effectively. This strategy works across all time frames, from the 5-minute chart to the daily chart, making it versatile enough to suit your trading style. So, but I would advise you look for this strategy and confirmations on the higher time frames, like from the 1 hour above, because it helps filter the noise, which is mostly seen on the lower time frames, like the 5 minutes or the 1 minute. So I would advise you use this strategy on higher time frames. So as we're looking at this, we just changed from bullish to bearish, as we had our cross. We had here you can see the 50-day moving average going below the 200-day moving average, indicating a change from bullish momentum or bullish trend to bearish trend. So we're looking to take sell positions. Now after seeing this crossover, the next thing is to look for major key levels which we can use to take trades, to take our short trades. So we have major key levels like this one. This is a major key level. this right here is a major key level, and we should be looking for price to either retrace back into this level before we can take our short trades. So the goal is not to just spot the crossovers and just take trades off of it. The goal is to spot the crossovers and look for additional confirmations. You can use candlestick patterns also, but I like to use price action. Using price action is better, as you can see resistance and support and resistance levels which have been tested over time, and it's expected that they should still work in the future. As you can see, we still have several touches on this same zone. This was formerly a support level. As you can see, we had price giving us a support level here, but the support failed, so it turned to resistance here. And you can see this liquidity, which is expected to be swept in the market. We let us swept it, and we have price reacting off of this zone later on about 3 more times. So you can see this is how you can use to trade. Remember, don't just trade when you see the cross. Trade when you see the cross and major price action key levels corresponding with that cross before you can take short trades or long trades depending on the crossover. And here I'm just going to target a 1:2 risk to reward ratio, or I could just target this major support level which has been holding on for so long. Just going to target it and expect price to take out that level, and we have a 1:3 risk to reward ratio here. Stop losses should be above major swing highs or key levels for a short trade like this, above major swing highs. So, and looking at further examples, you can see we have a ranging market. It's advisable not to trade when you have a ranging market because there could be several crosses, and it's not advisable to trade when you have a ranging market. Look for a clear trending market before you take your trades. So looking at this, we have a cross here, and one way you can use to know a ranging and a trending market is, this is why I like to take trades off of key levels. We had a cross here, and we should be expecting price to come back into this level, this resistance level here, before we can take a short trade. But you can see that level failed, and we have a cross. We have a major cross here, which helps us position ourselves to take buy trades. Now we have rising, we have this retracement and the push to the upside. So we'll be looking for retracements back into key levels. You can also use the Fibonacci to help spot key levels. So looking at this, we have the 61.8 level, and you have price reacting to the 61.8 level. I'm just going to take this zone right here, and this is a major one. This level, we reacted to this level once here and twice here. So this level is a major level, and we are able to take our buy trades from this area. Remember, spot the cross and wait for price to retrace to major key levels. It could be a Fibonacci, it could be normal price action, support and resistance levels. So we had this cross to the downside, and you can see price giving out a cross, the 50-day moving average crossing below the 200-day moving average. So we should be looking for opportunities to short this market, or we should be looking for selling opportunities. Now, after spotting the cross, what is the next thing? Is to look for key levels. This was a support level, but this support level is now resistance level because it was broken with force, and this level should be respected as resistance level. We call it support turned resistance. And as you can see, we have price reacting off of that to give us the push to the downside. Now we just place our sell order here. We place our sell trades at the confirmation of this candlestick patterns. We have several candlestick patterns here. We just need to see a major bearish candle like this here. So we just look to take our bearish trade from here, and our stop losses above our key level, our resistance level, and take profits at 1:2 risk to reward ratio. And that's how we're able to take this trade. And also you should note that moving averages act as dynamic support and resistance levels. So when price stays above both moving averages during an uptrend, it indicates strong bullish momentum. Similarly, price remaining below both moving averages during a downtrend suggests strong bearish momentum. So you can see price remaining below these moving averages showing us strong bearish momentum, and we can use these moving averages as dynamic resistance levels. You can see price reacting off of these levels when it gets to the 200-day moving average, showing us that indeed we can use the 200-day moving average for our dynamic resistance level. And you can see price also reacting off of that area. You can use this as a major resistance level. So you can see price reacting off of these levels when we hit, and also you can see that we didn't have any major cross, so we are still bearish. We should be expecting lower prices, and price reacting off of these resistance levels gives us a push to the downside. We also have price using the 50-day moving average as dynamic resistance level. See several areas here. So you may not just wait for a cross, you can also use this as dynamic resistance levels and look to continue your trades to the downside or to the upside depending on which side you're on. And we had a cross right here, and what is the next thing after spotting our cross? We should look for key support levels which we can use to trade off of. And you can see this support level here, and price reacted off of this support level once here and twice here. So we can look to place our buy orders at this level right here, or you could wait for a confirmation. If you are not an aggressive trader, you could wait for a confirmation from candlestick patterns like this one. We have this 3 inside up candlestick pattern. We've talked about that. So you just look to place your buy order here, and your stop loss is below, well below the support level, and you could target 1:2 risk reward ratio, or you could target this major resistance level here. That's how I would have used to take this trade using the moving average crossover and key levels. So the trend continued, and we kept on using the 200-day moving average as our dynamic support level, as we didn't have any major cross after that time. And we had a cross here, so we'll be looking for price to get to major resistance level. This is wonderful. This is wonderful. This is a major resistance level, and you can see price reacting off of that level. You can use this as your liquidity to be taken. Liquidity traders, SMC traders in the house, you can use this as your liquidity. And you see price, after we had this cross, price quickly reacts, quickly traces back into this key resistance zone. So we didn't just immediately start selling. Traders who place their sell orders here and their stop losses above this liquidity trap will get stopped out, and price will quickly tap into this resistance level and push to the downside. So this is why it's very wise to always wait for price to get back into major resistance or support levels before you take your trades. So looking at this, I'm just going to place my short trades, my sell orders here, and stop loss above this high. I'm going to take profits at major support levels like this one, or I could just target a 1:3 fixed risk to reward ratio, and we can use the 200-day moving average as major support level, major resistance level in this case. We're looking to continue the trend to the downside as we don't have any major crossover yet. And you can see this cross, that I had a cross, but this cross is coming after the reaction from this resistance level right here. Now this is a push to the downside. If you are a conservative trader waiting for another key level to take your sell trades off, you can see this major support turn resistance level happening right here, and just look to take your sell trades to push price downwards, and take profits at this support level. That's how we could just trade the market, keep on trading the market. It's easy. It's very easy. We've demonstrated it here together on the charts. And for this one, we just use the Fibonacci to spot key levels, and we have price reacting off of the 50%. And also, if I'm to use major key levels, major resistance and support levels, you can see this wick right there, and you see price reacting off of that wick to give us a buy entry right here. And that area is also the 50% level on the Fibonacci. So we just look to place our stops below the support level, and I'll take profits at major resistance levels like this one or this one above here. Or you could just place your take profits at fixed risk reward ratio of 1:2. And that's how we could keep taking trades off of the crossovers, and I hope you understand how you can use this strategy. Remember that no strategy is foolproof. Always stay disciplined with risk management and continue learning from each trade you make. You can save this video or share to your friends so that they can also learn how to trade using the double moving average crossover strategy. Alright traders, you've come to the end of today's video. If you found this video helpful, don't forget to hit the like button, subscribe to the channel, and turn on the notification bell so you never miss out on future content. Thanks for watching, and I'll see you in the next one.